Okay, let's get started. Subcommittee on National Security, Illicit Finance, and International Financial Institutions will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is entitled International Financial Institutions in an Area of Great Power Competition. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes to give an opening statement. First, thank you to our witnesses for being here today. You offer a wide and deep expertise on international financial institutions and global economics, and we look forward to your insights. Over the past year, in an effort to rein in the decades-high levels of inflation sparked by the reckless government spending, central banks shifted from a prolonged period of extraordinary monetary policy ease to one of aggressive monetary tightening. The Reserve, the European Central Bank, and the Bank of England all increased interest rates at the fastest pace in decades, while also withdrawing liquidity by not rolling over a meaningful part of their large bond portfolios. One consequence has been that 60% of low-income countries now face debt distress, meaning that there is a risk they may be unable to meet their financial obligations without debt restructuring or debt forgiveness, especially as global economic growth slows. This perilous international economic situation makes today's hearing especially timely and relevant. The international financial institutions were established after the Second World War to address global economic challenges, both to help cultivate economic growth and, in the case of the IMF, be the world's financial crisis firefighter. However, many now question whether these organizations remain up to or even focused on their core responsibilities. There are 2 major reasons for this. First, China has played a growing and uncoordinated role, providing funding far beyond what could be provided by traditional sources for white elephant projects that sink countries into debt traps. At least 65 countries owe China lenders more than 10% of their external debt. When countries enter financial distress, these large levels of opaque Chinese debt impede restructuring attempts, as the Chinese refusal to cooperate in the process leads to fears that any support will just flow to Chinese creditors rather than helping to resolve the borrowing nation's economic crisis. Ironically, at the same time, the World Bank continues to loan China more than $1 billion annually, and China remains one of the bank's largest debtors. China is also by far the largest beneficiary of World Bank spending. The GAO recently released a study entitled World Bank, Borrower Countries' Contracts to Businesses in U.S. and to Entities Potentially on U.S. Sanctions or Other Lists of Concern. That's a mouthful, which I would like to ask unanimous consent to submit for the record right here. The study found that between 2017 and 2021, Chinese companies won about 29% of all World Bank contract dollars. The second reason for concern without the IMF for the IFI's fitness is that these institutions are increasingly diverging from their traditional development agenda to impose Western elites' green agenda on the developing global South. Nowhere is that neo-colonial effort more clear than in the vital area of energy, where institutions like the World Bank will fund neither nuclear power, the cleanest, most productive zero-emission source, nor natural gas, the incremental improvement from coal or wood that allowed our country to reduce emissions more than any other country in the world. This, even as the European nations scour the African continent for alternatives to Russian gas for themselves, while hypocritically denying these very countries financing for our natural gas projects. In the meantime, because developing nations are demanding nuclear, gas, and mining projects that the bank sanctimoniously refuses to consider, Russia and China fill the gap, setting standards and establishing long-term relationships, even as the European countries and the Biden administration pat themselves on the back for their own green purity. In its budget request for fiscal year 2024, the Biden administration sought a 70% increase for IFIs, largely to fund this counterproductive green agenda. This Congress needs to take a hard look at how such an investment would possibly help hardworking American taxpayers, whether it would instead help Russia or China. The chair now recognizes the chairman of the Subcommittee on National Security, Illicit Finance, and International Institutions, the gentlewoman from Ohio, Ms. Beatty, for 4 minutes for an opening statement.
Thank you, Mr. Chairman, and thank you to the witnesses. Today, we are here to discuss the critical role of international financial institutions in the global economy and the increasingly large role that China is playing as a global lender to supplant U.S. leadership. And certainly, we know IFIs are in an era of great power competition. IFIs, including the International Monetary Fund, the World Bank, and multilateral development banks, are essential to provide financial assistance to countries in crises. support social and economic development around the world, and promote United States economic and foreign policy goals. In recent years, IFIs have been particularly instrumental in helping developing countries respond to the global pandemic, COVID-19, providing vital aid to Ukraine in face of its war with Russia and addressing the economic implications of climate change. While the United States remain a strong leader in the IFIs, other countries, particularly China and Russia, seek to supplant U.S. leadership and reshape international order. China Belt and Road Initiative, designed to craft a China-controlled global infrastructure, strategically seeks to lend and invest in developing countries to spread Chinese influence. To this end, China launched its own multilateral development bank, an Asian Infrastructure Investment Bank. These loans and investments come with strings and conditions that allow Chinese influence to become entrenched in borrowing country, from adoption of Chinese labor practices to the use of China's central bank digital currency. Through its obscure lending practices and unwillingness to restructure loans in line with global norms, China has been pushing countries into unsustainable debt. Now more than ever, it is critical for the IMF and other IFIs to have the resources they need to support low-income, at-risk countries so they don't turn to China for funding. That is why I can't fathom efforts by my colleagues across the aisle to hamstring and weaken the IMF when this institution is essential to countering China's influence around the world. To make matters worse, the United States may default on its debt for the first time in history as soon as a few days. There is no doubt that such unpredicted blow to the United States economy would deliver a decisive victory to China, collapsing the U.S. Treasury's market and catastrophically damaging our creditworthiness and credibility as a global leader. My colleagues on the other side claim to prioritize the economic threat posed by China, which I agree should be a priority, and yet their actions on default undermine that very goal. Destroying the American economy and Americans' credit, holding the payment of past bills hostage to railroad future spending cuts, unquestionably weakens America's ability to compete and continue as a great power. Meanwhile, committee Democrats in the Biden administration have led the charge to funding the IFIs and enacting legislative measures to protect and promote United States competition on the global stage. For example, from the CHIPS and Science Act to the American Competes Act. So I remain committed to continuing this vital work, preserving the United States standing as a great power in the global economy. I want to thank our witnesses for appearing today to discuss this important matter, and I'm hoping that my voice holds up. So please excuse it, and I look forward to your testimony today. Thank you, and I yield back.
We have 1 minute reserved for the chairman as well as the ranking member. The chairman doesn't appear to be here at this time, so with this, we will recognize the ranking member of the full committee, the gentlelady from California, Ms. Waters.
Chairman Lukemeyer and Ranking Member Beatty, I thank you for holding this hearing on international financial institutions, the great power competition, and how to best manage international programs to counter China's global ambitions. It is shockingly hypocritical, then, that we sit here on the last day that the House was supposed to be in session for the month, just days before Republicans run America's economy off the debt cliff. And why? At least one stated reason is so they can cut the programs and institutions like the World Bank, and other institutions. I don't know if the IMF is included in that, but however, this discussion today, I hope, will focus on not cutting anything in this government that has to do with us dealing with China and other concerns that we may have about how they're undermining not only our economy, but absolutely causing disaster in the world. I yield back the balance of my time.
Gentlelady yields back what time she didn't have. With that, we need to get a couple housekeeping things out of the way. First, French Hill, who is not a member of the subcommittee, is going to join us shortly and will be able to ask questions at the end of the discussion. We are going to have votes today, and right in the middle of our discussions here, so sometime between 9:45 and 10 o'clock. So we'll adjourn for a short period of time to go do our constitutional duty to vote on a bunch of bills this morning. We'll return and finish at that time, so you gentlemen will be able to go to the restroom, find something to drink, get a little nap, whatever it takes to keep you going for the rest of the morning. Also, with regards to your microphones, please, those things move. Please pull them as close to as you can. Some of them are very sensitive or not sensitive from the standpoint you need to get it close to you to be able to hear. When you become when you're at my advanced age, it's difficult to hear a lot of things, so I like to be able to hear everything you said and are going to tell us today. So please get those microphones close to you. Just take a bite out of it if you want to. That would be great. Okay, with that, we'll welcome our guests this morning. Dr. Jesse Schriger is an associate professor of macroeconomics in the economics division at Columbia Business School. Welcome. Mark Rosen, Mr. Rosen, a partner at Advection Growth Capital and former acting executive director of the IMF. Welcome, Mr. Rosen. Daniel Rundy. Mr. Rundy is Senior Vice President at the Center for Strategic and International Studies. Welcome to you, Mr. Rundy. Rich Powell. Mr. Powell is the Chief Executive Officer of ClearPath and ClearPath Action. Welcome to you, Mr. Powell. And Dr. Sam Ben. I'm sure we're all going to get his name wrong, so we apologize before, but hopefully that's pretty close. And with a name like Luke Tamar, I'm used to being called all sorts of things, so it doesn't bother me. Hope it doesn't bother you. But Mr. Sam Ben is a distinguished non-resident fellow and chief executive officer at AfroCatalyst. We thank each of you taking time to be here today. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be part of the record. I control the time with my gavel, so if you start here, that means it's close to time to stop. On your desk in front of you, you should have a timer. When you see the yellow button, kind of wrap it up. See the red button, means you're going to get gavelled out. So with that, Dr. Sugar, you're first this morning. You're recognized for 5 minutes. Please turn your microphone on, please. Thank you.
So Chairman Lukemeyer, Ranking Member Beatty, and members of the subcommittee, thank you very much for the opportunity to testify today. I'm Jesse Schrager, the class of 1967 associate professor at Columbia Business School and a founding co-director of the Global Capital Allocation Project. The international financial institutions currently face a significant challenge in the form of ongoing sovereign debt restructurings and countries on the verge of debt crises. Addressing sovereign debt crises and many other issues in the international financial system starts with an understanding of who owns what and who owes what to whom. At its core, a sovereign debt crisis arises when a debtor country is unable or possibly unwilling to meet the contractual value of its obligations. In such a crisis, the task at hand is to figure out how much a debtor is willing and able to repay its creditors, and then coordinate an agreement among the creditors to split the losses. This has always been a challenging problem since sovereign debt lacks the type of seniority structures or bankruptcy procedures that facilitate the resolution of corporate defaults. The difficulty of resolving a sovereign debt crisis is further compounded when creditors have differing objectives, especially when we lack a clear understanding of who the creditors even are. Today's debt challenges have many parallels with those of recent decades. In particular, the countries currently facing debt distress have largely borrowed from foreign creditors in US dollars and other foreign currencies that they do not control. This has left them vulnerable to external shocks, such as the rise in commodity and energy prices following Russia's invasion of Ukraine and the sharp recent increase in US interest rates. As their currencies lost value, these countries found it increasingly more difficult to repay their debt. As in previous sovereign debt crises, a successful resolution today will involve significant write-downs and losses by creditors, as well as additional lending from the International Monetary Fund. So in this sense, what's happening today looks like the past. But let me now turn to what is different about the world's debt situation. One key difference is that the largest emerging markets are generally not included among the list of countries in debt distress. Instead, debt problems are primarily concentrated in lower-income countries. One important reason why is that major emerging markets now largely borrow from foreign private investors in their own local currency. This means that even if their currencies lose value against the dollar, they don't see their required repayments increase nearly as much. This is a major improvement in the resilience of the international financial system. So, as the US and the other G7 countries consider scaling up lending from the multilateral development banks for infrastructure and other projects, it's important to do so in a way that helps low-income borrowers avoid dangerous currency mismatch as much as possible. The second difference today is the role of China as a global creditor to low-income countries. China is now the largest bilateral creditor in the world, and for some countries, debt from China alone can exceed a quarter or even half of their GDP. I want to highlight some challenges this raises. First, and related to my previous point, almost all of this lending from China is in foreign currency, and it's actually overwhelmingly in US dollars. Second, China's style of lending via its state-controlled policy banks positions it between conventional international private creditors, like bond investors, and other official bilateral government lenders. This has led to significant disagreement about how China should be treated in sovereign debt restructurings and is leading to costly delays. Third, there's uncertainty about just how much money is owed to China. China does not participate in traditional creditor reporting systems, and it tends to include non-disclosure clauses in its loans that prevent borrowers from revealing the terms. Fourth, some of the Chinese loans require borrowers to keep cash in offshore escrow accounts as collateral. This makes other creditors worry that China will be treated as the senior creditor in default if they can seize assets before formal debt restructuring negotiations even begin. Adapting the world of sovereign debt to reflect China's new role begins with a systematic understanding of the true nature of these exposures. The final challenge to the international financial institutions that I want to highlight is how tax havens and other offshore financial centers make it harder to know who owns what around the world. Because global financial statistics are recording to the immediate location of an investor or borrower, countries around the world don't even know where their money goes to or comes from. Let me give you an example. In 2019 and 2020, nearly $3 trillion of investment in stocks and bonds recorded as officially going to tax havens like the Cayman Islands and British Virgin Islands were actually going to Chinese firms. Closer to home, our official statistics report that our third and fourth largest portfolio investors are the Cayman Islands and Luxembourg. This means that we really don't even know who our ultimate creditors are. The problem is even worse around the world, where investment statistics lag behind what we have in the United States. The international financial institutions can play a unique role coordinating global efforts to look through tax havens and uncover the true pattern of global capital allocation. Knowing who owns what will allow the world to resolve future debt crises more effectively and efficiently. Thank you very much for the opportunity, and I look forward to your questions.
Thank you for that, Dr. Sugar. Mr. Rosen, you're recognized for 5 minutes.
Good morning, Chairman Lukemeyer, Ranking Member Beatty, and members of the Financial Services Subcommittee. Thank you for inviting me to speak with you today. I'm here to testify on matters relating to the IMF, where I served as acting United States Executive Director between 2019 and 21. Prior to being nominated by President Trump as his representative to the IMF, I was an investment banker for nearly 4 decades, most recently as head of Latin American investment banking and later chairman of that division at Bank of America. Firstly, a quick summary of the fund's core mission. The IMF is the global lender of last resort to countries that are in economic distress. IMF borrowers usually have a balance of payments problem, are running out of foreign exchange reserves, and so cannot meet their obligations. The IMF negotiates a set of economic policies with the borrowing government to alleviate the crisis, and conditional on the government implementing the agreed policies, provides a loan in tranches, normally over a 3-year period. Along with providing capacity development to countries and monitoring their economic performance, these are the key functions of the IMF. I would strongly recommend that this committee press the IMF to stick to these core functions and not to move into ancillary areas such as development lending or climate change lending or policies which have long time horizons far beyond the crisis focus of the fund. It's for development banks, and most importantly, the private sector, to invest in these longer-term issues and challenges, not the IMF. Secondly, the biggest challenge that the IMF faces today is China, which, as we've heard, has lent vast sums to emerging market and low-income countries in a non-transparent and irresponsible manner. Many IMF members are now struggling to repay China. The Paris Club of countries, of which the US is a member, acts responsibly in providing debt relief to these countries. But China's refused to join the Paris Club, and as we've heard earlier, has on numerous occasions also blocked or delayed debt restructurings among its debtors. The US and its allies need to continue to call out China and insist that it provides debt relief to these poorest countries in the same way the US and other members of the Paris Club agree to do so. And a stronger application of the IMF's lending into arrears policies in cases where China refuses to cooperate could be helpful in this regard. Another issue facing the IMF is the question of its ownership or quota. The United States is the largest shareholder in the IMF and has veto power over certain key decisions. And it's critical that the US continues to maintain its ownership at more than 15%, which enables it to have this veto power. China, for some time, has been pressing for an increased quota share at the IMF. However, given its irresponsible lending and unwillingness to provide debt relief to developing countries, this is not the time to reward China with increased ownership at the fund. Two other issues I'd like to focus on are anti-corruption and the catalytic role of the private sector in the work of the IMF. Corruption is a severe problem for many emerging market countries which do not have strong institutions that can confront and root out corruption. The IMF is certainly doing a much better job than it did historically on anti-corruption, but I believe it's critical that it continues to make anti-corruption laws and policies front and center in the conditions of its lending programs, as well as a focus of its technical assistance. Only by reducing corruption will many of these countries be able to attract the vast amount of private sector investment which is potentially available and remains the ultimate key to reducing poverty. Establishing a rule of law, including laws to protect private property, is key to unlocking this investment. And it should be a focus of the IMF and World Bank to encourage these countries to improve the rule of law and to fight corruption. If they do that, emerging market countries can attract private capital and grow rapidly, as many countries that have followed that path have already done so successfully. In conclusion, Mr. Chairman, my recommendations to this committee are for the IMF to stick to its core mandate and not stray into areas which require long-term solutions where other institutions are better suited to tackling these challenges, for the US to retain its veto at the fund, for the IMF and its member countries led by the US to insist that China provides debt relief to poor countries where it's overburdened them with irresponsible lending, and that the IMF makes anti-corruption and the catalytic role of the private sector in growth key parts of its conditionality in lending and technical assistance. Thank you, Mr. Chairman. I look forward to any questions the committee may have.
Thank you, Mr. Rosen. Good job. Mr. Runde, you're recognized for 5 minutes.
Chairman Luke DeMeyer, Ranking Member Beatty, and distinguished members of the committee, thank you. My main message is this. In this era of great power competition, if we do not meet the hopes and aspirations of developing countries, they're going to take their business to Russia, China, and others. We can't fight something with nothing. Multilateral development banks, MDBs, under U.S. and Western leadership are one way that we can respond with something. The United States built and strengthened the MDB system. MDBs provide money, advice, data, and convening power to help developing countries solve problems. If the U.S. exerts its influence over these institutions, they are force multipliers of a U.S.-led global system. If we disregard our leadership role, then other actors, including China, can exert influence over them. The World Bank Group is a series of institutions. It lends money to national governments, it has a private sector arm, it has an insurance arm. There are a series of other regional development banks, including the Inter-American Development Bank, the Asian Development Bank. Taiwan is a member of the Asian Development Bank, the African Development Bank, and the EBRD, the European Bank for Reconstruction and Development Bank, focused mainly on countries that used to be behind the Iron Curtain. The United States has been instrumental in creating the majority of these institutions and remains the largest or one of the largest shareholders of every aforementioned MDB. Since the founding of these institutions, the U.S. has used its shareholding power to shape the policies and activities of MDBs in indirect support of American foreign policy. The United States executive and congressional branches share control and responsibility for the United States policy towards the MDBs. There's been some talk about potential capital increases for some regional development banks. A capital increase is when an MDB increases the amount that it can lend through an increase in the bank's capital through one-time additional contributions from the U.S. and other shareholders. Congress has a voice and a vote in capital increases. The IDB and the EBRD may need capital increases. I'm in favor of that under certain circumstances. In the case of the EBRD, the Congress should only consider a capital increase if the EBRD agrees to use all additional monies generated to help the financing the reconstruction of Ukraine. How should we think about these institutions in the context of emerging market debt crises? Well, the MDBs play a number of roles in this, in the sense of responding to, they're a convener, they're a data collector, and they have a role to play in terms of any future debt deals. China is now a big part of the emerging markets debt problem. What role does China play in the MDBs? They're a shareholder. China continues to borrow from the World Bank and the Asian Development Bank. That is crazy. That needs to stop. China, as a shareholder, also has Chinese firms can bid on MDB projects. China wins a lot of, in terms of dollar value, a lot of the dollar value of World Bank contracts, something to take a look at. How does the Belt and Road figure into the MDBs? You all have heard of the Belt and Road. Infrastructure is now a strategic issue. China's Belt and Road Initiative is a combination of construction and financing projects for roads, airports, and energy around the world. Unfortunately for us, BRI is an ambitious project that speaks to the hopes of China's friends and potential friends. To counter the BRI, the U.S. needs a positive alternative that says more than, don't work with China, right? That's not a strategy. We've got to have an alternative. What is the role of MDBs as stewards of environmental protection? Well, under the Paris Agreement of 2015, each signatory had to file a national climate action plan. If these plans include oil and gas infrastructure, then the MDBs should support oil and gas infrastructure. MDBs also need to do more in mining and minerals. To achieve a carbon transition, we're going to have to produce 40 times the amount of cobalt and lithium. MDBs would rather have a root canal than work on mining and minerals. They'd rather not deal with it. If the administration comes to Congress for a capital increase for the MDBs, Congress should condition new capital increases on the revision to U.S. policy opposing support for oil and gas projects. I have several recommendations. First, the U.S. needs to ensure these institutions remain a force multiplier of a Western form of development. Second, mobilizing private investment should be a central focus of the MDBs. Third, MDBs should largely respond to client-driven demands. Fourth, the World Bank needs a much closer alignment with regional development banks. Fifth, these institutions need a more credible graduation policy for middle-income countries. And finally, any future capital increase for regional development banks should consider Taiwan joining as an economy.
Thank you, Mr. Runde. Mr. Powell, I recognize for 5 minutes.
Good morning, Chairman Lukemeyer, Ranking Members Beatty and Waters, and members of the committee. I lead ClearPath. We advance policies that reduce and remove global energy emissions. When I last spoke with this committee in 2019, the world's energy and climate landscape looked very different. Since then, COVID disruptions, Russia's savage invasion of Ukraine, growing tensions with China, unprecedented energy investments, and waves of extreme weather have shown that more energy and emissions know no borders. This committee can ensure financing to the developing world for clean technologies like advanced nuclear, particularly through the IFIs. I'll cover 4 topics today. First, the importance of nuclear energy and the latest American innovations. Second, our global competitors, particularly China and Russia. Third, the potential and challenges for IFIs in nuclear projects. And fourth, the importance of a parallel U.S. XM and DFC strategy for nuclear exports. An increase in demand for reliable, clean electricity has U.S. utilities calling for doubling our nuclear fleet by 2050. Military, big tech, and heavy industrial users are exploring a variety of advanced designs. There are 15 reactor concepts applying to the U.S. Nuclear Regulatory Commission. And today, at least 8 U.S.-based companies have publicly announced international partnerships to explore deployment in more than 10 countries. These partnerships could last a century, from construction through decommissioning. That said, the U.S. has lost market leadership to intense global competition for nuclear projects. In the last 5 years, Russian and Chinese state-owned firms captured 87% of all new construction starts globally. Today, China is building more than anyone, with 55 operable reactors, 23 under construction, dozens more in the pipeline, and a policy to go global through the Belt and Road Initiative. And it's not just the reactors. The U.S. is also vulnerable in nuclear fuel. By 2030, China and Russia could control 63% of global uranium enrichment capacity. There's more. From 2016 to 2021, China provided more energy project financing globally than all major multilateral development banks combined. Rapidly developing countries are looking for reliable, low-emissions power, but mainly, they're going with what's cheap. IFIs can and should play a bigger role in providing an alternative. Yet institutions like the World Bank have been slow to respond to the needs of these countries and even have a self-imposed ban on supporting nuclear projects, having not supported a single nuclear project in the past 60 years. As two of ClearPath's advisors noted in a recent foreign affairs piece, an Egyptian presidential advisor told us and a group of U.S. Republican lawmakers at COP27 last year, countries like hers want dependable energy and supportive financing. They would welcome U.S. investments, but we haven't been showing up to meet that demand. That's why Egypt instead took a loan from Rosatom and Russia for its new nuclear plant and is now locked into that relationship for the foreseeable future. Chairman McHenry's International Nuclear Financing Act would direct leadership at the World Bank and U.S. representatives at other IFIs to push for nuclear projects. Even if the bank and other IFIs removed their ban on nuclear financing tomorrow, it's not guaranteed we'd see more U.S. nuclear projects abroad. For instance, a recent study by the GAO found that Chinese-based companies received 1/3 of World Bank-funded international contracts over the past decade. Still, China remains eligible to borrow from the bank for its own development programs. Russia also remains the 8th largest shareholder for one of the bank's key lending facilities. As we consider pressing the bank and other IFIs to be more proactive on clean energy, particularly nuclear, we need to improve America's own export financing. One example, our recent successes in Poland. The Trump administration began these negotiations, and in 2022, this administration proposed a financing package. Poland chose Westinghouse's AP 1000 in a deal worth roughly $40 billion. This year, Exim and the Development Finance Corporation also signed an agreement to finance up to $4 billion for another Polish project that could support the U.S. export of GE Hitachi's SMR. A similar expression of interest for financing Romania's adoption of NuScale's advanced nuclear reactors was put forward at this past weekend's G7 leaders meeting. Unfortunately, this type of coordinated effort across U.S. federal agencies is the exception, not the rule. Representatives Donalds and Clyburn have introduced their International Nuclear Energy Act to enhance our competitiveness via a comprehensive civil nuclear export strategy. If we better leverage existing tools, enact these new policies, our all-of-the-above clean energy strategy will reduce global emissions. If the World Bank and other IFIs reassess their nuclear energy policies rather than simply defaulting to no, we'll be on a clear path. Thank you again for the opportunity to testify. We're eager to assist the committee in ensuring the U.S. regains its leadership in international clean energy.
Thank you, Mr. Powell. Dr. Semban, you're recognized for 5 minutes.
Thank you very much, Chairman. Good morning, Chairman Lutkemeyer, Ranking Member Betty, and distinguished members of the Financial Services Subcommittee on National Security, Illicit Finance, and International Financial Institutions. I thank you for inviting me today to testify at this hearing on international financial institutions in an era of great power competition. Before I begin my testimony, Mr. Chairman, allow me to pay tribute to the memory of music legend Tina Turner. We in Africa mourn her loss together with America. My name is Dauda Semben, and I am a distinguished non-resident fellow at the Center for Global Development and the founder and CEO of AfriCatalyst, a global development advisory based in Dakar, Senegal. I'm a former executive director of the International Monetary Fund, where I represented 23 African countries on the executive board. And during my tenure, I chair the statutory IMF Executive Board Committee, which is responsible for strengthening collaboration between the IMF and other multilateral organizations, notably the World Bank, the United Nations, and the World Trade Organization. Today, I would like to focus my testimony on the potential implication of the relationship between the United States and China at the World Bank and the International Monetary Fund. In addition to my written testimony, here are the key messages I would like to convey. First, I agree that the United States should constructively engage with major shareholders of the World Bank and the IMF and other IFIs, including China. This is important to enhance the ability of these multilateral organizations to help formulate and advance an ambitious shared agenda for supporting demands from their members and the global community. Second, when playing out within IFIs, great power competitions runs the risk of undermining the performance and effectiveness of these institutions, including by weakening their governance framework, complicating the consensual identification of their priorities, and reducing their resource mobilization potential. Therefore, I believe that the US policy on IFIs may have significant negative implications for these institutions, the world community, and the developing world if shaped by a non-cooperative stance with China. Third, there is a strong case, in my opinion, for the United States to use its leverage and influence to enlist IFIs in implementing US-led infrastructure development initiatives. This is in the best interest of both the United States and African partners, and its African partners. Closing the infrastructure gap is critical to fostering growth, reducing poverty, and enhancing the delivery of social services in Africa. But it may also be quite effective in advancing the US foreign policy objective, creating opportunities for US private businesses, and strengthening economic and commercial engagement with the continent. Finally, I will conclude by emphasizing the unique responsibility of the United States for ensuring that MDBs, multilateral development banks, such as the World Bank, are adequately endowed with necessary resources to fulfill their mandate. This includes providing timely and adequate funding to IFIs and contributing to capital increases. In this connection, I certainly agree with Ranking Member Betty on the need for significant US funding to IFIs. I also believe that capital increases for MDBs should be motivated by efficiency considerations and the need to optimize their ability to meet demands from countries and the international community. Thank you for your attention, Mr. Chairman.
Thank you, Dr. Sambeni. Fascinating discussion. Thank you all for being here this morning. Excellent testimony. With that, we'll turn to the members' questions, and I'll recognize myself for 5 minutes. In my opening statement, I referred to the GAO report, which I have here, and we'll enter in the record without objection. It was issued this month earlier, and it reveals staggering inequity in the values of contracts that the World Bank has awarded. All of you, or most of you, have referenced this report this morning with what you've been telling us. And so, despite the U.S. being the largest shareholder and contributing member to the World Bank, the U.S. business saw measly 2.4% of overall contract awards, while Chinese companies were awarded over 92% of all contracts. It's very disconcerting to see that not only some of this money going to Chinese companies that are on our U.S. entity list or sanctions list because they pose a significant risk to our national security, but there's also the discussion about whether they give the quality of construction and where the dollars are actually going that are of concern as well. So any of you that like to take that question to begin with, where do you see this going? How do we keep our funds going from these international financing organizations to the Chinese to then be able to go out and loan the money at a higher rate of interest to other developing countries whenever they really don't even qualify for some of these dollars themselves? I know several of you started to talk about this. Dr. Schroeder, you want to start out the discussion on that this morning?
Sure. So thank you very much for the question. So in my view, the most important part of allocating contracts is to go to the most efficient producer, because fundamentally the challenge with multilateral development bank lending, regarding procurement is if a project is produced over budget or inefficiently, it becomes harder and harder for the recipient country to return the funds. I can't speak specifically to the procurement process that led to selecting China or the United States, but fundamentally, allocating projects to the most efficient contractors is an important part of fostering the repayment ability and the efficiency of many of the MDB projects.
Mr. Rundy.
Thank you, sir. I think one issue is there's been a change moving away from the concept of a low bid to a concept of quality and life cycle cost. I think that's something we want to have across the developing world.
You say there is a movement, there is a movement to do that?
There's been a shift. The World Bank Group is sort of the standard maker in developing countries in terms of how countries buy stuff. And historically, the standard playbook was buy low bid. In the last several years, there's been a movement to attempt to move to quality and life cycle cost, and the World Bank changed the rules to allow that as a concept. We ought to be investing in training procurement officials in developing countries to have the concept of quality and life cycle cost as an approach to buying things. I know this seems a little bit obscure, but it's a really important issue. I think the other thing for us is, as the United States, we need to show up in a lot of developing countries, and sometimes some of it is, so I'm not excusing the fact that China's winning all of these contracts, but it may also be a function of we need to encourage American business to go abroad in different ways, whether through foreign and commercial service or whether it's so we can do certain things through the executive director's office at these regional development banks to encourage American businesses to look at opportunities through the MDBs.
Mr. Powell, follow up on that. It's concerning to me because a lot of the money going to these Chinese companies, they're nothing but shell companies. I mean, I serve on the China Select Committee, and we had a whole bunch of them, over 1,000 of them on the exchange for a while. We put some qualifications in place, and suddenly a bunch of them dropped off. It's down to like 257 now or something like that. And so basically there were shell companies that allowed the money to flow through them to the Chinese Communist Party. So these companies that are getting access to these dollars at the World Bank, are they the shell companies, or are they for real companies that are there in China? Are they just another extension of the China Communist Party?
Well, I'll say at the top, we just need to get a lot tighter on the requirements around these bids, both to Dr. Schrager's point that there's much more transparency about who actually is bidding into this, how the financial flows are going. We also need to be much clearer about whether we're, by frequently going with the lowest bid, if we're always preferential to heavily subsidized bids, right? We shouldn't be looking to always go with things that are then heavily subsidized by Chinese state-owned enterprises. The one other thing I'd note is in the instances where we do compete in these bids, we've got a great track record of winning. American companies have a great track record of winning. But some of the areas that we're most competitive, I'll just go back to our energy exports, our advanced nuclear technologies or our clean fossil technologies, those are just off the table at the bank and many of the other IFIs. And so we're effectively saying we can't compete for many of the most interesting.
Thank you. Thank you, Mr. Powell. With that, we recognize the ranking member, Ms. Beatty from Ohio, for 5 minutes. Thank you.
Thank you, Mr. Chairman, and thank you for bringing your expert information to us. All of you have basically mentioned how the United States needs to strengthen our role, or how we should try to maintain and not let others like China, i.e., have a larger percentage of interest with IFI. Also, I want to thank you, Dr. Saimban, for recognizing and saying that we need to strengthen social services and how important our infrastructure is. I agree with you as we look internationally, the same as we're trying to do here in the United States, because infrastructure plays a major role in what we're discussing today. So let me start with you, Dr. Saimban. And I'd like to start with the implications of the United States defaulting on its debt. I have a difficult time trying to separate where we are now and what we should be doing. We know that such a disaster would have a catastrophic consequences in the United States economy and spread throughout our global financial system. Is there anything you can lend to us with advice on how a default would affect other countries around the world and the international financial institutions' abilities to help countries in need?
Thank you very much for your question. Ranking Member Betty. I do fully agree with you that the potential debt default of the U.S. would be actually having dramatic consequences, not only for the U.S. but certainly also for many developing countries. As far as I know, for African countries that are borrowing from the markets, such an event might actually worsen the difficult tightening of financial conditions that they are facing right now, which would actually contribute to sort of undermining actually their access to markets, but most importantly also increasing debt servicing, which is already a problem in many countries that are facing a high level of debt. That's for one. I think another issue also is that event would, according to the IMF, actually have major consequences on the stability of the international financial system. And if that was to ever happen, I think that would be actually quite catastrophic for not only the global economy in general, but economies in emerging markets in developing countries. And certainly this is something that might end up actually having a lot of consequences, including not only on weakening growth prospects, but also having an impact on poverty, having an impact on the ability of international financial institutions to support those countries. And I believe that would be not necessarily the ideal situation. Thank you.
Thank you so much. Mr. Powell, we have all talked about, or all of you all have talked about the value of our stability in different ways and the impact that the United States should have on staying strong and fighting against China. Can you comment on the impact of the United States debt default of great power competition, particularly focused on the United States' ability to compete with China on the global stage and preserve its current standing in the global economy?
Obviously, the United States should not default on its debt obligations. There has to be a short-term strategy and a long-term strategy for that, which also needs to bring our spending into long-term, much more sustainable alignment, so that this does not remain a perennial issue.
Thank you, and I certainly agree that we should not be held hostage and have a ransom note of being able to turn our backs on those who also need our assistance. Let me move on and say first, thank you to Dr. Sambane for also recognizing the great talent of Tina Turner. That's very much appreciated. And I know in many countries in Africa what she meant to all of us. I'm probably not going to have time to have you answer this question, but being very impressed with your work and what you've done with the IF. I also have an interest in some of our close countries like the Caribbean. After being at CARICOM with then Chair Waters, we heard a lot about those lower income countries, and I will offline with you because my time is up. I yield back what I don't have.
Gentlelady yields back. They have called votes. We do have a screen here of where we are with our votes. We're going to try and get at least two more people in, Mr. Barr and Ms. Waters, before we adjourn. And if they're a little slow getting to the floor, we may get in another one. But we appreciate your indulgence. With that, we recognize the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. Thanks for the hearing. Thanks for the excellent testimony from our witnesses. So let me just quote from Mr. Powell and Mr. Rundy, our excellent witnesses here. Since 2000, China has become a dominant player in global energy finance, issuing more than $234 billion in loans for energy projects to some 68 strategically significant nations. For perspective, from 2016 to 2021, China provided more energy project financing around the world than all major Western-backed development banks combined. That's stunning. What I would like to know is, so the World Bank has this green agenda, and they're refusing to fund some of the most productive and lowest cost zero carbon energy sources like nuclear energy, or by supporting the mining of critical minerals necessary for these so-called green technologies. It seems as though for every World Bank fossil project turned down, China comes in with a bilateral loan, including for coal. So, Mr. Powell and Mr. Rundy, can you touch on how the World Bank's green energy policies promote China's reach into the energy space?
I'll go quickly and just to reiterate a few points on this. First, by the World Bank and IFIs effectively refusing to finance both nuclear projects and clean fossil projects like import of LNG technology or carbon capture technologies in places like South Africa that could desperately use them, we're opening a huge window to Chinese competition and frankly to Russian competition, particularly in the nuclear space as well. And we're holding back the export of U.S. clean technologies. I will totally reiterate Mr. Rundy's point about critical minerals as well being an urgent priority and very much off the table for many of these institutions.
Thank you, Mr. Barr. I think the MDB should have an all-of-the-above energy policy. I think it's a mistake. I disagree with the Biden administration on holding back on supporting oil and gas projects. Unfortunately, even when the Trump administration, when we pushed for supporting oil and gas projects, we would get voted against, the Europeans would vote against us at the board at the MDBs. So we're going to need to create a new coalition to support a diversification of energy. It's hypocritical of us when we have oil and gas and coal in this country, and then we turn around and tell developing countries they can't develop their own energy sources.
And we're playing right into China's strategy.
And absolutely.
So we have to use all of our influence to alter these policies at these international financial institutions. How do we end China's eligibility to borrow from the World Bank?
So we're in the Asian Development Bank has said they're going to end their eligibility by 2025. We should absolutely hold them to that. There is a temptation for the World Bank and the Asian Development Bank to continue to loan for a couple of reasons. One is they say, well, this is a window into how we can understand China better. There's lots of other ways to understand China better. And or this is a way for us for a bunch of lending reasons that they do it. You all have the power of the purse. You have an ability, you should have blunt conversations with the administration about this. I suspect it's an open door, but it's going to require, I think, some pushing from Congress. I would encourage this committee to push the administration on ending lending to China.
Yeah, we need to do that. I don't know which witness is the right person to answer this question, but jump in, whoever. The U.S. dollar remains the dominant reserve currency with about half of all international trade invoiced in U.S. dollars, half of international loans, global debt securities denominated in dollars. At the end of 2022, the dollar accounted for 58% of all allocated reserves globally. But we hear a whole lot about China's pursuit of a digital yuan. We hear a lot about the rise of crypto. We hear a lot about BRICS, a new potential multilateral currency developing. We hear about the Saudi deal with China denominated in the sale of oil in the yuan. Can someone talk about the threat to the dollar's reserve currency status?
Sure. I'm happy to start on this. So fundamentally right now, the renminbi it's not yet positioned to compete with the US dollar for a number of reasons. First and foremost, the reason that the dollar plays the role it does in the international financial system is it provides the global safe asset. You're confident, except for the upcoming debt ceiling, that you will always be paid back if you own US dollars. That's fundamentally what you know. When you contemplate investing in China and holding Chinese renminbi as reserves, you're not necessarily sure that you're going to be able to turn that piece of paper into the goods and services that you need or intervening in FX markets.
Fascinating discussion. I hope that another member will ask a follow-up on that. And Mr. Rosen, you have a chance at that point to make a comment, okay? We need to continue on. With that, the gentleman yields back. We recognize the ranking member of the full committee, Ms. Waters from California. 5 minutes.
Thank you very much, Mr. Chairman. I will direct this question to Mr. Samban. You were previously executive director at the IMF, representing 23 countries in Africa. So you are keenly aware of how China has been making significant investments into infrastructure of several countries in Africa. And of course, they've been doing this in the Caribbean, but I'd like you to continue to elaborate on the growing presence in Africa I mean, it is profound. Could you help us to understand what is going on in these countries?
Thank you very much, Congresswoman. On this issue, I would fully agree with what Mr. Daniel Runde said at some point. If the U.S. doesn't meet the hopes and aspirations of the developing countries, they will certainly look for alternatives. And alternatives are not only provided by China, of course, they are actually great ones, but they also provided by private sector also. And what is happening is, unfortunately, they have to do that and then, I guess, face much at a very expensive cost, in the sense that commercial borrowing is is very, very high. So what, in my sense, China has been doing is to respond to a critical need from Africa, which is the need for developing infrastructure. Infrastructure is found to be extremely important for fostering economic growth. It is extremely important for also improving the daily lives of African people by, whether we are talking about energy infrastructure or water or airports, all of that are critical, and Africa needs that. Unfortunately, they could not get those infrastructure from IFIs, or actually little of it. So, of course, they had to go and look for other alternatives, and China has provided that opportunity for many African countries.
Would you agree that our presence in Africa is less now than it was some years ago when we had Andy Young and some people paying attention to Africa, who was our ambassador to Africa? Do you see that we don't have a presence there much anymore?
Well, I would not say that you don't have a presence there, because I'm not going to comment on the diplomatic side, but on the economic front, what I can tell is, of course, the countries like China have been actually gaining a lot of influence in Africa, because, as I said earlier, there was a void, a gap to be closed, and they actually jump on it. And now, of course, the U.S., in my opinion, has been leading some very important infrastructure development initiatives. Recently, we're just hoping that they're going to deliver on those initiatives. If they do, I believe actually there is a really actually ample room for the U.S. to gain more from the African side.
Thank you. I'd like to say a word about the Caribbean. The Chinese are absolutely taking over the entire Caribbean. I know a little something about it. Ms. Beatty just mentioned that we were there not too long ago, and my husband served as ambassador to the Commonwealth of the Bahamas. And let me tell you, I just put together a few things that we've paid attention to over a dozen years. $30 million they paid for a stadium, $3 billion for a port, $40 million for another port, $54 million for a highway, $3 billion for a hotel, and another $250 million for another hotel. The whole footprint has changed in the Bahamas. Now, I want you to know that they have some needs. They have these hurricanes, and each year they're trying to pay to restore, their infrastructure. And so they get way behind. In 2019, in the Grand Bahamas, they lost their only hospital, and they're trying to build a hospital. We are not paying attention. The Chinese said, we'll build it for you. And when we were there, they were making a plea to us. We don't want to be indebted because we are already indebted. Can't you guys help us? I'm so pleased for this panel today because you're absolutely identifying the growing strength of China and its influence. And those people who love us and want to be friends with us, they're losing the ability to do it because we are not paying attention. So I thank this panel so very much for what you're sharing today, because these multilateral development organizations must be supported so that we can use our influence and keep our friends by helping them out and dissuade them from taking all of this from China, because they'll be indebted forever. I yield back.
Gentlelady yields back. With that, we, as you see over here on the left, our left, there's a screen that tells you where the votes are. Magic number is 100, so it looks like we've got about 5 minutes to go with one more questioner. That'd be Mr. Williams from Texas. At that time, we'll probably take a short recess. Mr. Williams from Texas, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here today. I want to follow up a little bit on what my colleague, Congressman Barr, was asking Mr. Schrager, to you. What is China doing to undermine the dollar's dominance as the world's reserve currency? And what should we in Congress and the administration do to combat it?
So first and foremost, thank you for the question. But first and foremost, what China is trying to do is essentially convince countries around the world that the renminbi is an alternative asset to invoice your trade and to invest in. And so on the investment side, they've been working very hard to actually allow in foreign capital, so encouraging foreign central banks to hold renminbi-denominated bonds as their reserves. And on the trade side, they're encouraging firms to invoice, basically price their goods in renminbi. There's a few areas in which they've had challenges there. So first, we actually don't know who are holding most of these renminbi-denominated assets. What you can see is after the US sanctioned Russia back in 2014, it was the Russian central bank that effectively announced they were moving out of US dollar-denominated assets and into renminbi. So they did that publicly. And so China has effectively been trying to attract foreign capital of that form. And a lot of the reasons for that is that China finds itself vulnerable in the dollar-based financial system. And so what I would say the fundamental area in which the United States can assure the dominance of the dollar is making everyone understand that US Treasuries are the world's safe asset, that there is no state of the world in which the United States can or will default.
It all gets down to selling, doesn't it? All gets down to selling, doesn't it?
I'm sorry?
Well, just promoting yourself. Talking about we need to do our job to make sure the world understands.
I would say so.
Right. Next, I'd like to ask, global interest rates have risen at the fastest pace in decades in response to high inflation. And as rates rise and the global economy slows, countries of poor creditworthiness face significant debt distress, and China has been unwilling to work with the IMF to restructure debts owed to them because of their desire to protect their country's credit rating, meaning that these emerging market economies are in serious jeopardy. So because the IMF has not been able to rein in China and their abusive lending practices, the Chinese have increased their own emergency lending and pose a great threat to the world economy. Mr. Rosen, how could the IMF address the pressure from rising interest rates, and how can the U.S. and the IMF better hold China accountable?
Thank you, Congressman. I think that's an important question. China is basically holding up the business of the IMF right now by not permitting these debt restructurings. They are basically, sometimes they indicate that they will agree to the debt restructuring. When you get into the details, they refuse to do so, as they have done in the case of Zambia. And then they ask the IMF and the World Bank themselves to take write-offs, which the multilateral institutions have never done. And it's completely wrong for the China to ask these institutions to do so, because they're already providing concessional lending at much lower interest rates than market rates. So it would be completely undermining and threatening the future of these institutions if they were to take debt write-offs. And I think the Chinese understand that, but they continue to push for it. I think what we need to consider is, first of all, we need to put enormous pressure on China with our European allies and others, all our allies, to agree to debt restructuring. But if they refuse to do so, then we need to look at a policy that the IMF does have in its toolkit, which is called the lending into arrears policy, which I referred to earlier, which basically means that we go ahead and we the IMF agrees to lend to a country in debt distress, and on the condition that it does not repay China with any debt or lending they get. Now, that's not a perfect solution, because unfortunately in the case of Suriname last year, my understanding is that we agreed to that, that Suriname agreed not to pay China, but they went ahead and by mistake apparently did pay China twice. So we need to work on mechanisms to prevent these countries, if they agree to it, to not pay China going forward. But I think that's one way that we can put more pressure on China in these situations.
Okay, I yield my time back. Thank you very much.
Gentlemen yields. We are getting close to the number over here. What we're going to do is recess. We have 2 votes. It should take about a half an hour, roughly, for us to walk over to the Capitol, cast a vote, and or 2, and then come back. With that, we'll have a short recess.